Assalamu alaikum. This is video 35 in which we are going to deal with question 4 of midterm exam. The records of Tech Incorporation disclose the following data. Quantity purchased is 5,000 kilos at a price of $5 per kilo. In addition, price variance of purchased quantity is negative 10,000 favorable. Second, balance at the end of inventory is 1,500 kilos and total direct material variance is positive 7,000 unfavorable. Required. Account for variances under two ways. Journalize and closing entries are required. Assume that balances at the end were 10,000, 1,000, 2,000 and 4,000 for web finished goods and cost of goods sold respectively. In addition, two ways is applied in a way that satisfies production department manager about the base of performance evaluation. Obviously, when you apply the two ways analysis in a way that satisfies production department manager, it means you figure out quantity variance net and price variance gross. This is very important to note. Now, to journalize entries, we have first to figure out actual and standard quantities, also actual and standard prices. So first, we are going to deal with how to figure out standard price. Why? Since we have the price variance of purchased quantity. Also, we have quantity purchased. Also, we have actual price. So easily we can figure out standard price by applying the equation of price variance for purchased quantity. The variance equals actual less standard prices times quantity purchased, 5,000. So standard price equals $7 per kilo. Then we are gonna figure out actual quantity used. That's very easy. Since purchased quantity is 5,000 kilos, while ending inventory means unused quantity is 1,500. So used quantity is 3,500 kilograms. Then, through applying price variance gross, since we are seeking for the way that satisfied production manager, so we need quantity variance net and obviously price variance gross. Now, price variance gross equation states difference of prices 5 less 7 times actual quantity. Why we use to apply it on price variance gross? Since we had actual quantity, we don't have till now. We didn't have till now standard quantity allowed, so we can't apply it on price variance net. So 5 minus 7, that is negative 2 times 35 equals negative 7,000 favorable. Accordingly, quantity variance net equals could be computed through the total variance first. Total variance less price variance gross give you quantity variance net, that is 14,000 unfavorable. Accordingly, quantity variance net as positive 14,000 unfavorable equals difference of quantities actual less standard quantity allowed times standard price. Accordingly, standard quantity allowed is 1500 kilograms. So entries shown as first entry, that is to record purchases that debits inventory based on standard cost of purchases, and credit accounts payable based on actual cost of purchases. Standard cost of purchases equals quantity purchased times standard price, 35,000. While accounts payable, quantity purchased times actual price of purchase, 5,000 times 5, this is 25,000. Then price variance appears as credit since it's favorable. So favorable variances are credit by default. Second entry, to record using direct material. To record using direct material, and obviously to record quantity variance net. So debit web, amount of standard quantity purchased times standard price, while credit inventory, amount of actual quantity used times standard price, and the quantity variance net appears as debit 14,000 since it's unfavorable. Then to close related price variance of inventory. Total price variance is 10,000, while 10,000, while price variance net as previously computed was the price variance gross, was 7,000 favorable. So the related price variance to inventory equals 3,000, 10 less 7. So close it first. Since price variance was favorable as credit by nature, so to close you debit. So debit price variance amount of 3,000 and credit inventory. Second, to close variances, that is the other component of price variance, 7,000. Also you need to close quantity variance. Quantity variance was 14,000 unfavorable debit. To close you should credit. So you will debit price variance amount of 7,000 and credit quantity variance amount of 14. Then web finished goods and cost of goods sold appear as debit to balance the entry. Obviously total variance was 7,000 is classified, is divided among them based on balances. Balances were 1, 2, 4. So 7,000 are divided as 1, 2, 2, 2, 4. So shares are web 1,000, finished goods 2,000, cost of goods sold 4,000. So this is the end of the video. I'm gonna meet next hopefully.